Cap intro events have become a major component of many alternative investment managers' fundraising strategy, and we're here today to talk about why cap intro events are taking on an even greater importance as we're heading into 2022. If you are a manager, it's important to know how to increase the effectiveness of cap intro events you participate in, and what are the differences between cap intro events, and how to make the best use of the multiple Florida cap intro events this January. But first on, we'd like you to talk about the current fundraising environment. You recently wrote a paper titled "The Greatest Asset Raising Environment in the History of the Hedge Fund Industry." Can you tell us why you think this is?
Hey, thanks a lot. And by the way, the paper I wrote is also on Opalesk. If you haven't read it, I hope you look it up. I think there's some really good information there. But basically, I've been doing this for 36 years, and I've been fairly negative on the capital raising environment over the past, let's say, 10 years, because most of the flows going to managers are coming from redemptions from other managers. So our firm has raised a lot of money, don't get me wrong, but it's been hard. There hasn't been much net flows into the industry. And when I look at the three things that drive flows, all of them are pointing to record flows over the next 15 months. And the three things that determine flows are: one, how big the market is, what the turnover of managers are, and what the net flow is into the industry. So number one, asset size of the industry. We're at an all-time high as of end of the second quarter, $4.3 trillion, which is up almost a trillion dollars over the past few years. So before I mentioned, up until the last 24 months, most of the flows since 2008 have been kind of a recirculation of assets in the industry. We really haven't had much net flows in the industry, and all the growth has really come from performance. So the bigger the asset base, the more money, assuming a constant rate of manager turnover, is going to circulate within the industry. The second reason I think flows are going to be an all-time high is I think turnover is going to be at an all-time high. And there's a number of reasons, I think this. So, for example, let me tell you how important turnover is. Over the past 10 years, probably 75% of the time, net flows in or out of the industry have been plus or minus $100 billion. Well, just think of the current size of the market at $4.3 trillion. And then just assume the average investor holds a manager for 7 years. If they do that, that's going to be 15% of the market's going to turn over each year, which is $650 billion moving hands if you had a static turnover rate long term. If that turnover rate goes from 15 to 25%, you're talking over $1 trillion turning over within the industry, which is good if you're a good manager and really bad if you're a bad manager, because it means people may redeem from you. So why do I think turnover is going to be higher? Well, the first is just pent up demand. Most hedge fund allocators want to meet with a hedge fund manager before they give money. And a lot of allocators have put searches on hold because of COVID. They're not going to the office. They're not traveling. So you have this huge amount of pent up demand, which is going to be temporary. Once offices open, people travel. A lot of these searches that have been put on hold are going to happen, and you're going to see a significant increase in turnover because of it. A second thing that's going to increase turnover is just the dispersion of performance. When you have very limited performance between managers and certain strategies, people tend not to get fired. When dispersion widens out, turnover increases. Over the past 2 years, you've had huge turnover because you've had this massive sell-off in the marketplace, massive rebound, and there's just numbers are all over the place in strategies. So that's going to lead to record turnover. And the last is that, over the past 18 months, you've had a lot of change in the capital markets. So the relative valuation of different types of securities has changed, and you're going to see some people shifting what strategies they want to hold in the portfolio, which will also cause an increase in turnover. And the third reason I think you're going to see record asset flows to new managers is just net flows in the industry. In the last 12 months have been very strong. They might have been the strongest 12 months we've had since before the financial crisis of 2008. We saw about 150 billion come in the industry. I think it's going to continue. It's going to continue for three reasons. One is performance has been very good for the industry. Before 2020, it was pretty mediocre when you look at hedge fund industries. But first quarter of last year, hedge funds did a great job of outperforming the indices when the market sold off. They rebounded. We're up about 10% on the year. People are very happy with that. We started this year, best first 6 months since 1999. That's given investors confidence in the industry, leading to positive flows. Another is everybody's fully invested. You know, it's a takeaway game in this industry. And a lot of these institutions have a lot of money in fixed income, which is earning, 2%. And the diversification benefits of fixed income have gone away. It used to be inversely correlated. The equity markets sell off, fixed income market would do great. Well, when interest rates are close to zero, they can't go much lower. So you can't get that negative correlation during the equity market sell-off. In addition, when interest rates are low, you have higher duration of your portfolio, which makes you more interest rate sensitive to rates going up. Money coming out of fixed, going into hedge funds. The third is fees have come down. There's now a two-tiering of fees where institutional investors are getting discounts. It's going to cause more demand for hedge funds. Bottom line is, this is the best asset raising environment for hedge funds we have ever seen. And if you're a money manager, you saved a lot of money on travel, you saved a lot of money on marketing expense. Now is when you want to go all in, because once all this search activity happens, everybody's portfolio is going to be refreshed, and I expect search activity to go down.
Thanks, Don. A lot of managers have given me the feedback that there is a wide disparity of success they have at cap intro events. All things now being equal, what is some advice you can give to hedge fund managers to increase the probability of success while participating in these events?
The first thing I'll say is, I put on cap intro events and I see who's getting meetings, who's not getting meetings. And I can tell you that there are people that sign up for cap intro events and don't send any invitations to managers. And they call up and are like, hey, we don't have any meetings. And it's like, well, you have to send invitations to get some meetings. I mean, some investors are going to randomly pick you also, but it goes both ways. So if you're doing a cap intro event, you have to be proactive, send invitations. And as you just mentioned, you have to mention when you send these invitations why they should consider you. Well, what are the key differentiators for your firm? The second thing you need to do if you do one of these cap intro events is just remember you got 30 minutes. That's it. So, you may be used to doing a presentation over an hour. You got to really focus and get it down to 30 minutes and probably get it down to 20 minutes because they got to walk from one meeting to another. And it may take them, 10 minutes to find your booth. If you're doing it virtually, you get a little bit more time, but make sure you can present in the time frame and that the meeting isn't ending when you're 2/3 of the way through. There are 15,000 hedge funds. And I've been on investment committees of pension funds. I've been calling on pension funds for 36 years. They are literally getting 10 to 15,000 managers contact them a year across all asset classes, all strategies. With hedge funds, they're probably getting thousands. They're probably doing meetings with 200 to 500 a year. They're probably doing follow-up meetings with 50. And most of these pension funds have small hedge fund portfolios. They may have 10, 12, maybe they hire 1, 2, 3 managers a year. So it's extremely competitive, and they're looking for a reason to get rid of you. They have to narrow it down, and they're looking for little teeny reasons. So any bad answer or any poorly articulated description of what you do is going to result in them thinking very highly of you and thanking you for your time, but they're going to hire your competitor. Performance is a screen. You have to be in the top 25% of your peer group to get business. If you're not there, you're not going to get any money. But if you are there, you have a shot. But once you're there, it's multiple factors people are looking at. If it was all about performance, you could put your data in, one of these hedge fund industry databases, fire all your salespeople, and just wait for investors to invest in your fund. And the reality is, putting your data in a database, you really don't get much money. So always start out with talking about your organization and how it's of institutional quality and how you've built the appropriate infrastructure. When you talk about your investment staff, you need to talk about, their backgrounds and what their background has done to allow them to implement whatever your investment philosophy and strategy is. And I highly recommend you build everybody up on your team and just not talk about just PM. When I went to Andor, which peaked as one of the largest hedge funds in the world, when I first got there, the two leading principals, bio was huge, and then everybody else was teeny tiny, like a couple sentences. And I said, we need to build out this whole team, especially when the two top guys didn't want to meet with anyone, and they didn't want to meet with anyone, and all the investors wanted to meet with someone important at the firm, and they didn't want to meet with someone whose bio was 2 sentences long. So we basically equalized everybody's bio, and it really helped. We were really successful raising money, but it did help a lot, and it made investors happy to meet with various people on the team and so forth. The most important thing you need to do is really be able to describe what inefficiency in the market you're going after and what your differential advantage is to capture that inefficiency. If they don't understand that, you're probably not going to get hired. If they do understand that, very high probability that you're going to get hired. And this is something that most managers do a really bad job of. Especially on the long short equity side, a lot of them just say the same thing. They're not differentiated. And what I would recommend is have a philosophy page. A philosophy page just talks about, here is the inefficiency, and this is what I believe you need to do to capture that inefficiency. And if you have academic proof to back it up, that's even better. And then the investment process implements that investment philosophy. No one is hiring a manager because of their historical record. Everybody is hiring a manager based on their future record. Anyone can be lucky. If you have a investment philosophy people understand, and you have a process people understand, and they think it's repeatable, they're going to be much more likely to invest with your firm. Portfolio construction and risk controls are extremely important that they are described well. And it's extremely important that they are structured in a way that people want to buy them. Once you have all that, I'm going to go back and repeat what Matthew said. You should script it out. When I was head of institutional sales for Merrill, I got my entire institutional sales force involved, the PMs involved, to come up with the best way to describe our organization, team, investment philosophy, process, risk controls. Certain people had better ways of describing things. Certain people had better examples, and we scripted it out. And then I had a video camera, and I would sit there, and my sales team would come in one after another and have to present to me the script. Now, they could alter it a little bit, but, I wanted consistency of message. I wanted everybody to be presenting the same thing. I didn't want anyone winging anything. I wanted everything to be exact. And this also truncates the presentation because it eliminates a lot of useless words that you do. It gets you down to the time you need to do these cap intro events. It also has to be linear so people can write notes and articulate it well to their coworkers, organization, team, philosophy, process, risk control, in that order. Practicing it over and over again, I think is very important. I represent a lot of managers, some that are outstanding, and they have not taken advice on how to present. I'm sitting in meetings and I am just dying because they are imploding and they think they're doing a good job. And I know there is no chance that we're going to get any money from this investor. And so there's no reason to spend all this money on hiring a big investment team and an office and all these analytics and doing all this stuff and not spend a little time fine tuning your presentation, which could be the difference between getting a lot of assets and not getting a lot of assets. You should also script out commonly asked questions.
Absolutely.
So the same questions tend to come up over and over and over again. And with all these previous firms, I headed up sales, we'd get everybody to tell us what questions they ask, and we'd work as a team to come up with the best answer. And a poorly worded answer can get you eliminated. So it's worth the time to script that out and make sure you answer it as well as possible and as accurately as possible. You don't want to be winging stuff in presentations. One thing, follow-up's obviously important because a lot of people have very long due diligence processes. They require 4 or 5 meetings, and you need to help work them through that. The other thing that a lot of people don't realize is a lot of these investors don't remember what you said before. You know, like a year will go by, we'll go see someone, and I'll be like, you definitely give a summary. It's like, no, I already said that last time. It's like, they've met with like 500 people since they met with you. They don't remember. I mean, some of these people take great notes and they read them before the meeting, but you should never assume that. You need to keep reminding them over and over and over what you do, and be prepared to obviously go in a lot more detail on various things the second meeting. But that's one of the biggest mistakes people make.
What is the difference between cap intro events run by prime brokerage firms and independent cap intro events?
The first thing I want to say is, as I mentioned before, I think this is a terrific environment to raise assets for hedge funds. And as a result of that, I think hedge funds should be participating in multiple events, both prime broker and also independent. When you look at the history of prime brokerage cap intro events, they've been around for over 20 years. And they're basically started as a way for prime brokers to differentiate their firms from their competitors by giving away cap intro services to their hedge fund clients. And hedge funds have used this as a major factor in determining what prime brokerage firms they want to associate with. As a result of that, in general, prime brokerage cap intro events tend to be very heavy on long short equity managers, where independent cap intro events tend to be much more diversified as far as strategies go. So I think that the two different type of cap intro events are very additive to one another. In addition to that, I think when you look at the major independent cap intro events, there's a case that you could make that there's potentially higher quality managers. And let me tell you why I say that. Obviously, prime brokers want good managers at their cap intro events, but they also want to promote those managers that are generating the highest revenue for their various organizations. When you look at these cap intro events, they cost money for managers to participate in. So only those managers are going to participate in these events that think they can be successful. At the end of the event, there's actually a report card on how they did. And that's how many meetings did they have that were high quality. And what you tend to have happen is those managers that had a lot of meetings are going to sign up for the next event that organization puts on. And those that don't have a lot of meetings are not going to sign up again. So you have this gradual improvement in the average quality of managers that participate in these independent events. They also tend to be dominated by a lot of mid-sized managers, where some of the major cap intro events are skewed more towards the largest managers. And I actually think some of these large managers have evolved to the point where their assets are so large that it's difficult for them going forward to generate the same returns that they did historically. In addition to that, when you look at prime brokerage cap intro events, a number of them tend to focus on group meetings. And don't get me wrong, you want to get in front of as many people as you possibly can. And there's a lot of value to participating in those. But all things being equal, I think a one-on-one meeting is more valuable because you have more dialogue. There's a greater concentration by the investor and the particular manager. And these independent events tend to be focused more on one-on-one meetings. In addition, a number of these independent cap intro events have very sophisticated platforms where managers can input their information. Investors can go in and can screen managers based on strategy. They can sort managers based on track record, Sharpe ratio, and a lot of other variables. Managers can also see what investors are participating in, what strategies are interested in, and can send invites to managers that are interested in their particular strategy. These cap intro events also tend to be larger as far as number of managers that are participating.
Tell us also, what's going on in Florida this January?
In Florida is basically there are 4 primary competitors relative to independent cap intro events. The first competitor is a firm called Context Summit, which was really the pioneer of successful independent cap intro events when they purchased a firm called Alphametrics, and they've been putting on a great event in Florida for a number of years. Recently, some of the employees from Context Summit left to form a competitor called iConnections, and the 2 of them are putting on events in Miami at the exact same time. In addition to that, a third primary competitor is a firm called the MFA, or Managed Fund Association, that started off more focusing on the CTA marketplace, but over time has broadened what their focus is. And they also have a lot of panels at their conferences that feature large institutional investors. I think they do a very high quality conference. It tends to be more medium size. And those 3 competitors are all doing events on the exact same days. The last event is Gaining the Edge Cap Intro Florida, which is put on by our organization. We've been putting on alternative investment events since 2013. We've done a fairly well-known conference in New York that has sold out 7 years in a row with approximately 700 registrations. We've also done a webinar series where we've had 21 episodes and have averaged about 1,000 people per episode. And then over the past year, we put on 2 virtual cap intro events. The last one we did earlier this year was the largest cap intro event in the history of the alternative investment industry. We have picked the week before the other 3 events to do our event. Our event ends on a Friday. We are also having a golf tournament on Saturday, and the other 3 events start the following Monday. We've purposely done it the week before because we don't want to overlap the other 3 events. In addition to that, we want people to be fresh at our events. If you've ever been to a cap intro event, after the first day, people tend to get pretty fried, and you begin to see a lot of no-shows of meetings the second day. And we want everybody to be energized at our event, especially those that are going to be attending multiple events. The event is associated with a marketing firm called Hedge-Fund Partners that is considered one of, if not the top alternative investment marketing firm in the world. Hedge-Fund has spent the past 15 years developing very strong relationships with investors on a global basis that come to our events. Our events tend to be pretty unusual in that we have typically a lot more investors come than hedge fund managers. In addition to that, a number of investors that come are proprietary to our database, or just people that we've met over the years that a lot of other people don't know. And as a result of that, the overlap of investors with our conference and our competitor conferences tend to be pretty low. There's only about a 25% historical overlap of people that do both. So it's additive to these other events. In addition to that, we price our event lower than our competition, which means it's very high return on marketing dollar. We also are being very flexible in how people participate. Some people will participate virtually. Most will be in person. If there's a flare-up in COVID, we're going to allow managers to convert their registrations from in-person to virtual, and we're going to refund the difference in price. And finally, like all of our events, we donate a majority of the profits to charity. Since 2013, donated almost $3 million to charities that benefit at-risk youth, and we're looking forward to donating a lot more after this event. And with that, I hope to see you all in Florida. Thanks for watching.
Opalesk is a media partner of the Gaining the Edge Cap Intro event in Palm Beach. Use the link below bit.ly/cap_intro to benefit from the low Tier 1 pricing, plus get free benefits valued at $600 US.